It wasn't the Fed. It wasn't Al earnings. It wasn't some geopolitical headline scrolling across the bottom of CNBC on some of the wildest single days in the stock market over the past few years. The thing actually moving the S&P 500 wasn't news at all. It was math, mechanical boring. Forced math happening inside a market most people don't even know exists. And here's the part that should bother you. This market now moves more money in a single day than the entire GDP of most countries on Earth, and almost nobody watching the ticker has any idea it's there. Because underneath the stock market, you check on your phone, there's a second market. It's called the options market. And on a lot of trading days now, more than $2 trillion of notional value changes hands inside it. That's not a typo, 2 trillion in one day. And most of that volume isn't even long-term positioning anymore. It's something called zero-day to expiration options, or ODTE, contracts that are placed and expire on the exact same day. In 2016, this stuff barely existed. Today, some measures put same day options at more than half of all S&P 500 options volume, which means the market you think is being driven by earnings and interest rates is on any given afternoon actually being driven by a casino that resets the felt every 24 hours. But to understand why this matters, you first need to understand who's actually on the other side of every single one of those trades. Because when you buy an option, you're not trading against the market, you're trading against a dealer, usually a bank or a market maker. And that dealer's entire job is to stay neutral. They don't want to bet on direction. They want to collect the spread and go home flat. So the second they sell you that option, they immediately go hedge it by buying or selling the actual underlying stock. This is called delta hedging, and it's the quiet engine behind almost every mysterious market move you've ever seen. Let's make this simple. Meet Sarah. Sarah thinks the S&P is going higher today, so she buys a bunch of call options, expiring this afternoon. The dealer on the other side sells her those calls. Now the dealer is short calls, which means if the market rallies, the dealer starts losing money on that position. So to protect themselves, the dealer buys shares of the actual index to offset the risk. But here's the twist. As the market keeps rising, the dealer has to keep buying more and more shares to stay hedged. That buying pushes the price up further, which forces the dealer to buy even more. It's not conviction, it's not a bullish thesis. It's a machine reacting to itself. This is called being in a negative gamma or short gamma regime, and it's the mechanical reason markets can suddenly rip or crater with no news attached at all when dealers are short gamma. Their hedging amplifies whatever direction. The market is already moving. Up becomes more up. Down becomes more down. It turns the stock market into a feedback loop instead of a pricing mechanism. And it gets worse because gamma isn't the only Greek letter running the show. There's also vana, which measures how a dealer's hedge changes when volatility itself moves, and charm, which measures how a hedge decays purely from time passing, with zero change in price at all, which means on ODTE heavy days, dealers can be forced to buy or sell billions of dollars of stock, not because anything happened in the world, but simply because the clock ticked forward. Analysts at places like Spot Gamma and Goldman's Derivatives Desk track this stuff daily because institutions have figured out something retail investors haven't. On a lot of trading days, price discovery has nothing to do with discovery at all. And now, back to the trillion-dollar casino. Because once you understand dealer hedging, you start to see it everywhere. Remember the sudden, violent volatility spikes that come out of nowhere, wipe out a chunk of the market in an afternoon, and then fully reverse within days. Those aren't always driven by some new piece of information. A lot of the time they're driven by options positioning unwinding all at once. When enough short-dated puts get triggered near a certain price level, dealers who were hedged one way suddenly have to flip and hedge the opposite way. And that flip alone can move an index percentage points in hours. This is also why the market has started behaving strangely around certain days of the month. Why moves that should take a week now happen in an afternoon. And why traditional technical analysis, the stuff about support and resistance lines, works less and less like it used to. Those price levels aren't really about buyers and sellers finding equilibrium anymore. A huge amount of the time, they're about where dealers are forced to hedge full stop. So, who's actually driving this? It's not just retail traders buying meme calls on their phones, though that's part of it. It's also systematic funds running options overlays, pension funds selling covered calls for income, and corporations hedging their own balance sheets. All of that flow lands on the same dealer desks, and all of it gets absorbed into the same mechanical hedging engine. The stock market isn't just a place where people bet on companies anymore. It's become the visible shadow of a much bigger. And this is exactly the kind of story traditional financial media has no interest in touching, because stocks rallied on strong jobs data is a headline you can read in 4 seconds. Stocks rallied because negative gamma forced dealers into a mechanical buying spiral that had nothing to do with the jobs report. Doesn't fit in a Chiron. It doesn't trend. It requires you to sit still for longer than a tick-tock. So instead, we get the simple story. The story with a clean villain or a clean hero, even when the real explanation is sitting one layer underneath, in plain sight, moving $2 trillion a day. So the next time you see the market rip, or crater, for seemingly no reason, don't reach for the news app first. Reach for the options data. Because on more days than Wall Street would like to admit, the headline isn't the cause of the move. It's just the story someone told afterward, to make the math feel like it meant something, if you want to actually understand what's moving your money instead of getting fed the simplified version. Hit subscribe because this is the stuff that never makes the headlines, but it's the stuff that actually explains them.